Legislation a couple of months ago in my office, although I know it's been on the agenda for most of the people here for more than 4 or 5 years. Because as you all know, lending is what gets people into housing, mortgage lending gets people into housing, and predatory lending, unfortunately, is what keeps people out of housing in the future, or gets them out of their current homes. One of the things that we really want to do here this morning is to understand the current state of where Connecticut is in relationship to the rest of the country, how its protections for predatory lenders stack up to protections around the country, and maybe get some thoughts from all of you on where we should be going and where we should be moving on this issue in the future. We have 2 speakers this morning. The first is going to be talking about the Connecticut anti-predatory lending protections, and the second will be giving us both a national and a local perspective. Our first speaker is Andrew Pizor. He is currently working for the Consumer Law Group in Rocky Hill, Connecticut. He graduated from Georgetown University Law School, or from Georgetown University undergrad, and from Fordham Law School. He initially worked for Legal Services, which is where my heart is after I started my legal career, and is now working for the Consumer Law Group, representing the victims of predatory lending and also doing other consumer protection type work. So please join with me in welcoming Andrew Pizor, and then we will hear from Uriah King. Thank you all very much for coming.
Good morning, everyone. It's really a pleasure to see that there are so many people who are interested in helping protect consumers from predatory lending. It's a new, relatively new issue. It's kind of risen to the consciousness of a lot of people who deal with consumer borrowers. Just kind of to illustrate the situation, the problem, and how the laws that currently exist relate to it, I'd like to just give you kind of a sample scenario of a loan that one of our clients might walk in with, or someone that you might hear about. So just imagine that husband and wife, they've owned their home for a few years. They've got about a $200,000 balance on the loan. Depends where you live in Connecticut, I guess. Right now the loan is a fixed rate, a 30-year loan, about 6% APR, and they pay about $1,400 a month, including escrow. Now, this is kind of a composite loan of different clients I've met, so if the numbers don't quite sound right to you, please just suspend reality for a minute. So, as I mentioned, $1,400 a month payment, including escrow. And they decide, they've got a lot of credit card debt, car loans, so they think maybe they'll refinance. But the property values have gone up, and we'll do a consolidation loan. So they call a broker that a friend recommended. And they talk to them, they explain what they want, they talk about their house, what they think the value is. The broker asks the usual questions. And the broker, makes things sound good. He says, oh, I think we can really help you out, here's what we'll do. I think we can get you the loan you're looking for. And they explain what they're interested in. They want to try and keep around the same payment, but they've heard interest rates are lower, they'd like to get a lower rate, but still borrow some more money. And they've heard that, given the way rates have changed, this is all possible. So the broker reassures them that it is possible, says he'll get right to work on it, and he sends them a good faith estimate in the mail, estimated good and lending statement, and it shows something that they're really interested in. Loan for about $240,000, 5%, $1,300 a month. So they're really pleased. Later on in the month, the broker calls them and says, okay, we've got the closing all scheduled, it's all set. So what they're told is that the lender's representative is actually going to come out to their house. They want to make it feel convenient, they know they work. So they'll come out to their house at about 4 in the afternoon, and they'll meet them there. Well, 4 o'clock comes and goes, nobody shows up. So they give them some more time. They get a call from the broker apologizing, I'm sorry, we got lost on the way. Maybe 1 or 2 more calls in. At 8 o'clock at night, the broker and his notary finally show up. Say, okay, we're ready to do the loan. And understandably, this husband and wife are a little annoyed. They've been waiting, but they want to get it done. And the broker says, the lad's you're still here. We want to get it done because your rate lock's going to expire tonight. So they go over the papers, and the broker and the notary, they kind of chat about things, and whether it's a really nice car you have and things. And the borrowers don't really read most of the papers. They're talking, they're frustrated, they want to get it done since it's late, but they still want the loan. So, as they're talking, they're turning pages and signing, notices, okay, sign here, going along talking, kind of almost as undoing it. They're not really looking down. And at one point, something catches their eye, and they say, oh, wait, this says something about that there's no escrow. And the broker says, oh, that must just be a mistake. You can go ahead and sign everything. Give the lender about a week to get all the papers in your account, and then you just call them until you learn an escrow account. Will be taken care of. So the borrowers, kind of look at each other and say, well, we want to do the loan. So they go ahead and they sign everything. And the notary leaves, the husband and wife, they give it a few days, like the broker told them to. And they call the lender. And the lender says, well, sure we can add an escrow account, but that's going to add a couple $100 a month to your payment. And they talk about the loan some more. The broker won't return any of the calls. And eventually, between looking at the papers and talking to the lender, they realized that the loan they really ended up with was 6.4% adjustable rate instead of fixed. The payment's $1,500 a month instead of $13 with escrow. It's $15 without escrow. This adjustable rate goes up almost every 6 months. And then they notice interest rates are climbing in the newspaper. That's why they want to refinance now. Plus, on top of it, it's adjustable that it never goes below the initial rate. It pretty much only go up or back to the initial rate. And then to top things off, there's a 3-year prepayment penalty. They want to refinance. It doesn't pay off all the credit cards like they asked. And instead, the money that they wanted to go to the credit cards, that $11,000 of that, it seems to be going to the broker's commission and the settlement charges. So they're hopping mad. They come to you, or they come to me and say, well, what can we do? And I look over the papers, and I tell them, I'm really sorry, but this is legal. You're stuck with the mortgage. You could refinance and pay the prepayment penalty. And definitely upsetting to them. It's very frustrating to me because I realize how they've been mistreated. But a lot of the laws, some of them, the business community, the loans that are loan products, as they call them, it's a nice heady phrase. The products are always moving a little bit ahead of the law. So they come up with new transactions that are legal and that they're very profitable to the industry. And the problem is, it's easy to fast talk a borrower into something that's not necessarily affordable, especially if things have changed at the last minute. We see a lot of bait and switch claims, which is pretty much what I just described to you. Or we hear something that sounds good, but they get to the closing and it's not what they wanted. Some people notice it at the closing and realize what's happening, but for various reasons they feel they've been trapped into the loan. Maybe the broker said, oh, don't worry about paying your credit card or your current mortgage this month, because you're just going to refinance all that. So they feel they can't walk away. But it's still legal. And that's what I want to get to in discussing some of the laws that Connecticut has. I'm not really going to go into the federal legislation. That's a whole different area. And I think we're all here in Connecticut, this is a little more relevant. One of the major Connecticut laws is called the Connecticut Abusive Home Loan Lending Practices Act. The acronym is even worse, so I'm not even going to try and pronounce that. But if any of you have heard of COPA, the Federal Homeowners Equity Protection Act, the Connecticut version is pretty much modeled on that. It has a few more protections. Well, okay, I'll get to the extra protections. First of all loans, it says there can't be any prepaid finance charges. And a lot of the closing costs, for those of you who aren't familiar with other definitions, closing costs are usually considered prepaid finance charges, such as broker's commission, myriad of processing and administrative fees. Those are usually prepaid finance charges. Under the Connecticut law, there's a daily interest between the time you sign the loan and the time your first payment is due. That's not included. Just I guess, the legislature can define things however they like. So all those charges, not including the interest, the daily interest, can't add up to more than 5% of the principal of the loan, or $2,000 if it's, well, we don't see so many loans with closing costs of $2,000 anymore, just because, the economy, inflation, and everything. So that puts a pretty good restriction on the type of loans we see. We don't see a whole, in fact, actually, I've looked at several hundred, and I haven't seen any that went over that 5% cap. But the problem is that there are lots of other ways that people can get into trouble without that law being violated. Just for your interest, that cap is even stricter if it's one company refinancing its own loan within 2 years. And that's a good protection, but there are lots of other gaps, loopholes. The rest of the abusive loan, the rest of the Abusive Home Loan Lending Practices Act is only triggered for mortgages that have a 10% rate, 10% greater than the yield on Treasury securities at the time. So, that's a pretty high interest rate, and fortunately, luckily for people in Connecticut, those loans aren't made too often because the rate is so high and the restrictions are so great under this law. But there's a whole range of things that can happen beneath that, and the description I just gave, that loan is completely legal, and it isn't covered by the Abusive Home Loan Lending Practices Act. A lot of the problems that we see start with the brokers. Brokers originate, or help originate, a huge percentage of the loans that are made today. And there are a lot of promises that can be made by brokers, or even, not necessarily legally enforceable promises, but just suggestions that they can do these great things for borrowers. The example I mentioned where the broker sends out an estimated truth in lending good faith estimate has great numbers on it, but then they're all switched at the closing. Could be any number of reasons. Sometimes the broker says, "Oh, I'm sorry, something changed," or the lender changed programs, all kinds of excuses. That problem originates with the broker making the promises. But under the way the various regulations are, that change is legal. The borrower still has time to walk away, whether it's a practical matter or not. The person doesn't have a whole lot of complaint because they sign the papers, and the lender and the broker say, "Well, you saw it, you had a chance to walk away." It's not really a realistic situation for most borrowers to walk away, and loan transactions are so complicated that it's, when you're faced with an inch-thick stack of papers and someone rushing you to sign them, it's not surprising that people don't catch these things. I was at a continuing ed conference, and I heard a lawyer who does real estate transactions himself. He was doing a refinance. Actually, I think it was in his wife's name for some reason we didn't go into. Anyway, the closing agent came to the house, and his wife said, "Well, you can go over the papers?" He said, "No, just sign them. They're all fine." And people are trusting. I mean, it's with good reason. So, you have to be really suspicious to decide, I'm going to spend an hour reading through all these complicated papers. And that's why we need legal protections that will cover the steps leading up to the transaction. Getting back to brokers. Brokers are lightly regulated in Connecticut. And I know there's someone from the Banking Commission here, so I don't mean any offense. But basically the regulations, as far as I'm aware of them, they have to be licensed. The application does ask for things like criminal record. And they have to post an insurance bond of about $40,000. But there's not a whole lot more. There's no rules that I'm aware of requiring them to disclose their compensation in the transaction, how they're getting it, and other factors that might impact the price of the loan or the borrower's confidence in deciding whether or not I can rely on this person. Remember, the broker is an independent businessman. He's not obligated to get the best loan possible for the borrower, unless, of course, he makes that promise or that's somehow arranged. But borrowers don't always know this. And regarding the $40,000 bond, that certainly sounds good, but a lot of brokers are small companies, and we've tried to sue a number of them, and they're hard to catch up with. Sometimes they go out of business, they stop paying the bond, the insurance lapses, and the consumer's left holding the bag. Sometimes it's not even really the lender's fault, it's the broker that set up the problem. So, as I think Mr. King's going to talk about later, there's room for some new legislation, there's room for improvements, and well, if anyone's interested in talking about it more, I'd be happy to discuss it with them. One last quick point I'll make. A representative from the Center for Responsible Lending contacted me just a day or two ago, and they're looking for customers, borrowers, with basically predatory loans. 228s, unaffordable adjustable arms, option arms, things like that. They're trying to put together some testimony for Congress and for the media. So if anyone's interested in contacting her, just let me know and I'll give you the information. Thank you.
Thank you. The case that you illustrated was based on some of the calls that we've gotten, some of the complaints that we've received in my office. The next speaker is from the Center for Responsible Lending, and we will have a chance for questions and comments at the end. In particular, I think about some of the issues that you're seeing or the issues that are going on in the clients that you have coming into your office, or in issues that you see that are actually hurting the industry, hurting the brokers, hurting the lenders because of the bad apples that may or may not be out there. Our next speaker is Uriah King. He is from the Center for Responsible Lending. He began his anti-predatory lending work in Ohio, working for the Miami Valley Fair Housing Center. Ohio, by the way, is the state in the country with the highest foreclosure rate. And they are seeing a lot of the effects and the really negative effects of predatory lending that has gone on there. He began working for the Center for Responsible Lending in 2002 and has worked with other New England states around the issue of predatory lending and around the issue of legislation. Most recently, he was in Maine and also is talking about working with some of the folks in Rhode Island. The Center for Responsible Lending, for those of you that don't know, is a nonprofit, nonpartisan research and policy organization dedicated to protecting homeownership and family wealth by working to eliminate abusive financial practices. As you just heard Andrew mention, there are going to be hearings in Congress during the next several weeks on the issue of predatory lending, the brokers' part in predatory lending, and what lenders are out there that are possibly contributing to the problem of predatory lending. And so Uriah is going to give us an overview of what's going on nationally, but also how Connecticut compares to that. So Uriah King.
For many folks who have never had the opportunity. We've done over $4 billion in home, small business, and nonprofit community development financing, which includes, just recently, which is kind of exciting to me, we financed the acquisition of setting aside almost 20,000 acres for a state park. We do charter schools with fire runs here in Connecticut. As both a lender and secondary market player, we serve borrowers who do not meet traditional underwriting criteria. We're basically subprime lenders. The reason we focus on home ownership, it's pretty clear. I mean, you know, it's not only the only, it's probably the best shot that most low-income families get to build wealth, to really have something to weather financial storms, to put a child through college, and to leave something on to their children. You know, equity wealth, the difference, if you look, I'm not going to use some of the statistics today, but if you look at some of the statistics between homeowners and non-homeowners and their net wealth, particularly in the low-income and minority communities, it's staggering, usually by at least a factor of 10. The disparities are, and it just reinforces the point that homeownership and building equity within a home is the best way for low to moderate income families to build wealth. Also, it seems like every week there's a new research paper that comes out that says the higher the homeownership rate, the less crime. The higher the homeownership rate, the higher voter turnout is. It just goes on, and it seems like every other week there's a new research paper that reinforces that. I'm going to get right into it. The subprime mortgage market. The subprime mortgage market, these are some broad trends. About 3/4 of the subprime market are refinances. A lot of the rhetoric around the subprime market is we're getting people into homes. Well, that's true, and subprime lending is a factor in the record home ownership rates in the country. It's not the primary factor, which I'll talk maybe if you're interested about that. But here it says, 3 out of 4 subprime mortgages, the refinances, typically debt consolidation, cash out, home improvement, rapid growth, over 1,000% in the last 10 years. I've seen estimates, 1 out of 5, 1 out of 4, it depends on what data set you use. Every mortgage now in this country is a subprime loan. Drastic change in access to credit. I can't emphasize this enough. And I mean no disrespect to all the people that worked on these issues before me, but the CRA movement is changed fundamentally. I mean, it is not about access to credit anymore. It is about terms-based credit. I mean, believe me, you can get a loan. It is not, it's not, I mean, I'm not saying that there isn't redlining going on. There is evidence that redlining is still going on. That is not what's driving the marketplace today. There has been a financial services revolution. There's a whole lot of reasons for that. Do I need this?
Yes.
People can't hear me?
It's just helpful for them.
All right. So the important thing I want to emphasize is that the economic justice and civil rights issue today is non-denial of credit in terms of this credit. What is predatory lending? You're going to hear this an awful lot. Predatory practices, I have 2 slides on this. This is the setup. Predatory practices are concentrated in the subprime market. Most abuses that we talk about as predatory lending are not fraud. They extend well beyond fraud and things like unfair trade practices. And specifically, and there's more about this on my website, on the Center for Responsible Lending website, Connecticut law does not address most established or emerging practices. Let me give you one example. In the northeastern region, only New Hampshire and Connecticut are the only states that have no reasonable limitation on prepayment penalties. All the rest of the states in this region do. Federal Reserve Board Governor, at least former Federal Reserve Board Governor Graham, noted that just for the safety and soundness and unfair and deceptive trade practice, there is not and should be no final definition of the term predatory lending. For us, predatory lending is a component of subprime lending. They're not the same, with 3 mostly legal components: fee-based equity stripping, steering and targeting, and practices that unnecessarily increase foreclosures. Predatory lending in Connecticut. 6,000 families qualify for compensation in Household America suits. That's roughly 1,000 families a year. And let me give you one example real quickly. And I know you just had a vacancy for it. I'm going to move through this really quickly. Of a household. My first involvement with predatory lending was investigating one of these lenders. And I'll give you real quickly, a gentleman, he was 67 years old. He was contacted by households refinancing debt, and his credit, he had, by the way, had a 720 FICO, and folks know what FICOs are. That's really good credit. He did have some debt. He had a 7.9 and a 9.9, 2 credit cards, one 7.9, one 9.9, pretty good rates. He ended up taking a refinance and got a 30-year, 2 mortgages, a 30-year mortgage and a 15-year second. The terms of the 30-year mortgage was 7.5 upfront points, which worked out to be about right at $8,000 upfront discount points, quote unquote. Had a 13% interest rate and had a 5-year, 6 months interest prepayment penalty. So it means if he were to refinance any time within that first 5 years, he'd pay another $6,000 for the benefit of that credit. Also, he paid another $6,000 of single premium credit insurance that if he were over the age of 65, he couldn't claim, but then he couldn't claim on the policy. He was 67 when he signed on the contract. All those fees came together and pulled out every bit of the last equity he had in the home. On top of that, on the junior mortgage, which he used to actually refinance the 2 credit cards at 7.9 and 9.9, he got a 25% interest rate, 3 points, and another 3-year prepayment penalty. This is a person with A credit. Now, this gentleman was a victim of household. And household's defense is like, well, it's just this rogue loan officer in Dayton, Ohio. It's just we got a problem, we know, we're going to clean it up. Well, as it turned out, Washington State, Minnesota, California, these stories, it all came out everywhere across the country. What I just told you was the typical borrower. I mean, he was probably the average. There were stories out there, I've heard them and seen them. This was nationwide. There are 6,000 of those families right here in Connecticut that has that same story. And what we're struggling to know is that based on analysis that we've done, most of those practices are perfectly legal in this state. Connecticut is tied with Arkansas for the 4th highest incidence of predatory loan terms in the United States. The other states is Indiana and Florida, and I think there's one other. I'm sorry, I can get that to you, but I shouldn't blank on it. And also, take a look at rate sheets specifically for Connecticut if you want additional information about how underwriting, how yield spreads are being paid in the state. And victims matter. We hear so much about, oh, that's just one story. I gave you an example of a household story, and it turned out that was a nationwide phenomenon. He was a representative sample. And that's it, victims matter because, that's the basis of, I want to step back for a second and be a bit philosophical. That's the basis of scientific method. Is you go out and you observe individual instances and you build a case and you make inferences about what's really going on in the marketplace. That's what people, when scientists go study an issue, they collect victim stories, if you will. It's the same logical process. Equity stripping practices. These are excessive fees, including prepayment penalties and basically junk fees. Mortgage broker kickbacks, also called yield spread premiums, which I can go into more detail in a moment. Refinances that provide no benefit to borrowers, they're just used to generate fee income, and sale and financing of unnecessary insurance and other products. Good. Steering and targeting, steering borrowers toward subprime loan products rather than prime products. Freddie Mac, 1 out of 5 subprime borrowers could have qualified for a prime loan. That's a travesty. Hyper marketing, abuse of both products, so failing to provide prime products to African Americans, Latinos, elderly, or low to moderate income families. We have targeting and disparate impact information for each one of those groups. And charging rates, fees, and prepayment penalties unrelated to risk. As you can see, these things all tie together. For example, minorities have a 35% greater odds for prepayment penalty in their loan. And now here's the double whammy. Our research suggests that penalties mean either no rate savings to refinances or actually higher rates with purchase money mortgages. We control for the borrower, the type of home, the economy, the credit risk of the borrower, all those things. Essentially, a subprime prepayment penalty is a form of rent. I would argue it's a form of rent seeking in the subprime market. Here's some maps here specifically in Connecticut. Subprime lending patterns and behavior. As you can see, the predominantly minority, predominantly low-income neighborhoods, and are the brown and the white, and below the green are below 8% of household income. Now look at the subprime lending concentration. See how that matches up. Go ahead, go next. Here's Bridgeport, GDP. I think it's even more clear. You can see minority areas and see where subprime lending is concentrated. Predatory practices increase risk of foreclosure. There's going to be a lot. We're going to hear a lot more about these practices in the next few weeks. If you've been following some of the national media like Business Week, Wall Street Journal, you're hearing an awful lot of talk about some of this. And there's going to be hearings next week in the U.S. Senate, which I strongly encourage everyone to listen to. I think they're going to be, a blockbuster. Excessive interest rates not justified by risk. If you're steered into a more expensive loan, you got to pay more each month. Or paying more each month increases the risk of the loan. Subprime prepayment penalties. UNC researchers found that controlling for the borrower risk and the economy and other factors found that just having a subprime prepayment penalty in your loan increases the probability of foreclosure by 25%. Unsuitable loan products, floating arms and balloons. I'll talk a little bit more about that in a minute. Unfair and deceptive underwriting practices, appraisal inflation, service and collection abuses, and mandatory arbitration clauses. Foreclosures in Connecticut. As I said already, researchers have linked the use of terms such as prepayment penalties, certain unsuitable loan products, subprime arms, and subprime loans with higher rates of foreclosure. In Connecticut has the second highest cumulative foreclosure rate in New England. May is first. 1 out of 8 loans originated in 1999 has had a foreclosure filed. Now, imagine if 1 out of 8 Ford Explorers blew up. What would happen? There'd be a massive recall, right? Something to think about. Subprime mortgages account for 16% of originations in Connecticut, but 66% of foreclosures. Here's incomplete. I just wanted, these are, I think some of this is part of the solution. I don't, you know, I know we kind of get into semantics about what education disclosures and whatnot, but, you know, they are part of the solution, but they're not the solution. Federal price fixing mandate, the borrowers receive a particular loan. I mean, if this doesn't work with something complicated and situationally dependent as a mortgage. Improve education disclosure. You know, according to the Department of Education, 22% of the adult population in this country is functionally illiterate. And then once we teach all these people, you know, teach people to really read and write, so we're going to start talking about net present value and underwriting based on the teaser rate, and come on. And plus, let me say, just emphasize this. I can't emphasize this enough. No matter how brilliant or how sophisticated, or you know, you're an attorney for the mortgage industry, there will come a time, inevitably, when you will become vulnerable. It's called age. You know, that's one of the reasons why, you know, people get exploited. No matter how brilliant you are, or how, you know, much wealth you may have, think you have, there will come a time when you're vulnerable to these guys, and it's going to get older. The other thing is, I say, in the subprime market, it is by far more complex than the prime market. The types of products, the type of the way the loans are priced, across the board, it is more complex than the prime market. But yet, typically, the more unsophisticated borrower has to deal with a more complicated market. It's an unlevel playing field from the get-go. Improved enforcement. This is something you know I hear probably more than the first two. One thing is that most practices are legal. Enforcing something that's against something that's legal doesn't really get you very far. And most relevant, even though there's this laundry list of federal laws that apply, the vast majority of them are primarily concerned with disclosure.